Hello everyone, and welcome back to the Quant Lab. Over our last few sessions, we have mapped the spatial boundaries of the market using Fibonacci, Ichimoku, and the Ganfan. Today, we are opening a new chapter on spatialized frameworks. We are shifting our focus away from spatial geometry and strictly into the dimension of time. Today, we master the DeMark Sequential, developed by Tom DeMark, commonly known as the TD sequential or the nice 13 count. This algorithm solves a massive problem in quantitative finance. Traditional oscillators like the RSI tell you if a market is overbought or oversold. But in a strong macro trend, an asset can stay overbought for months. DeMark realized that the critical variable is not the condition itself, but the duration for which that condition persists. The system is divided into two distinct phases. The first is the step setup 9, which measures immediate momentum exhaustion. For a bearish exhaustion, which we call a TD buy setup, the algorithm looks for 9 consecutive trading days, where the closing price is strictly lower than the closing price 4 days prior. Mathematically, CT must be less than CT minus 4 for 9 days in a row. If even a single day falls this condition, the momentum is fractured, the count is destroyed, and the algorithm resets to 0. Conversely, a TD sell setup occurs during a rally, looking for 9 consecutive closes higher than the close 4 days ago. When a 9 prints, immediate momentum is mathematically exhausted. Okay, to use this indicator in your trading app, you just need to find the DeMark sequential from your indicators, then you click it, and then you can see 1 up to 9. If it satisfies the relationship that we have just introduced in a row for 9 days at least. Okay, so let's look at this live example of the sell setup on the S&P 500 daily chart. Retail traders often buy into green candles because it looks strong. But look at this chart. The algorithm flawlessly identifies 4 distinct, separate instances of bullish exhaustion. In each of these 4 rallies, the moment the strict 9 count is completed, the prevailing momentum stalls, and the price pushes back. For example, after we count for 9, okay, so each of them, the closing price is higher than the 4 days back. For example, this day's closing price is here and higher than the 4 days ago's closing price. And after the 9, we see this on this day, after 9, the closing price is, well, it pullbacks a little bit, but we are not comparing this with the 4 days ago, but we're going to talk about it, that this one is lower than 2 days ago's price. So we can see some pullback right here. And similarly, after this 9, we can see some pullback right here. And then after this 9, a pullback right here. And then after this 9, a pullback right here. And this perfectly illustrates how institutional algorithms use the 9 count. We do not use it to blindly short the market, but we absolutely use it to take profits and anticipate localized reversals. You never want to be the person deploying fresh capital into a mature nine count. Okay, let's get back to the lecture. Well done, setup 9 identifies short-term exhaustion. The second phase of the algorithm, the countdown 13, identifies macro-structural exhaustion. Once a 9 is successfully completed, the countdown phase begins. The math changes here. First, the 13 count does not need to be consecutive. It can take weeks or months to build. Second, the lookback period shifts from 4 days to 2 days. For a buy countdown, the algorithm counts every day where the close is lower than the close 2 days prior, which means CT less than CT minus 2. When this count finally reaches 13, the macro downward move is considered mathematically dead. Okay, so let's look at the daily K-line for S&P 500 in March 2025 to see this macro exhaustion play out. So here, we see that following an initial setup 9 printed in magenta, the algorithm begins the non-consecutive countdown phase. The market continues to bleed lower, grading out those numbers until it finally prints the definitive 13 right here. At the very bottom, the selling pressure is mathematically exhausted. So let's see how we count it again. For example, this will be a 10 because the closing price is lower than the closing price 2 days ago. So we have a 10. And 11 here because the closing price is lower than the 2 days ago closing price. So we have 11. And apparently here is 12 and 13. And then it goes back to here, but actually we have a 14 here, because this one is lower than that one. Then the market goes up from here. Okay, so let's get back to the lecture again. But here is the most critical lesson of this lecture, or golden window execution rule. Notice what happens right after the 13 or 14 point prints. A clear, strong bullish reversal candlestick forms. This is your entry signal. One of the biggest mistakes retail traders make is buying the exact second a 9 or 13 prints. If you do that, you have no logical place to put a stop loss, but the price is still falling. Instead, in the Quant Lab, we wait for the 9 or 13 to alert us that the math is exhausted. Then we wait for a definitive structural confirmation, like a bullish reversal candle or an oscillator cross, to actually trigger the trade. This gives us a highly definable stop loss directly below that reversal candle. Let the math find the zone, but let the price action pull the trigger. And of course, we will talk about the structure in the next chapter. See you in the next section.